The gambler's fallacy, also known as the Monte Carlo fallacy, is a cognitive bias. It is the mistaken belief that past random events influence the probability of future random events. Frequent events will soon lessen a false belief. Conversely, if something happens less frequently than normal, it will happen more frequently in the future. The gambler's fallacy leads to irrational decision-making. This bias affects behavior in contexts involving probability and chance. The gambler's fallacy can negatively influence trading decisions. It involves the mistaken belief that past events affect future probabilities in random events. Traders may assume a series of gains or losses makes a reversal more probable. This assumption leads to flawed predictions about price movements. Such misjudgments can result in poor investment choices and financial losses. The gambler's fallacy is the mistaken belief that past events affect independent future outcomes. In trading, it manifests as assuming a stock's past performance predicts its future direction. A trader might short a stock after consecutive gains, expecting a pullback based on this fallacy. This ignores crucial market context and fundamental analysis. Acting solely on the gambler's fallacy can lead to poor trading decisions and potential losses. Financial markets operate based on complex factors, not random chance. Daily price movements are driven by new information entering the market. Market dynamics and investor behavior also significantly influence price fluctuations. Past price streaks or patterns do not reliably predict future market behavior. Traders sometimes assume an asset's price will revert to its moving average. This assumption is often based on the belief that the asset has deviated too far from its perceived fair value. The duration of the deviation is also considered in this assumption. However, this approach often neglects the importance of underlying market conditions. Ignoring market conditions can lead to inaccurate predictions and poor trading decisions. The gambler's fallacy involves perceiving patterns in random events. This often manifests as believing a trend will reverse based on past occurrences. For example, expecting a price bounce after a down day simply because it happened before. Such beliefs ignore the underlying randomness of price fluctuations. The gambler's fallacy is a misconception regarding probability in random events. It incorrectly assumes past outcomes influence future independent events. This fallacy clashes with the concept of market efficiency in finance. Market efficiency suggests current prices reflect all available information. Therefore, past price movements alone cannot reliably predict future price changes. Overtrading can occur when traders are influenced by the gambler's fallacy. The gambler's fallacy leads to the mistaken belief that past events affect future probabilities in independent events. This fallacy causes traders to believe a losing streak is likely to reverse, or vice versa, regardless of actual market conditions. As a result, traders may enter and exit positions based on these false probabilistic beliefs. This behavior occurs instead of relying on sound analysis and rational decision-making. Confirmation bias can significantly affect traders' decision-making processes. Traders might selectively recall instances supporting their pre-existing beliefs. This selective memory reinforces the trader's conviction in a particular fallacy or strategy. Conversely, traders tend to overlook or forget instances where the trend continued against their belief. This biased recall creates an inaccurate perception of market dynamics, potentially leading to poor trading decisions. The coin toss mindset is a common example of a logical fallacy. After a series of identical outcomes, people often expect the opposite result to be more probable. For example, after 5 heads in a row, one might incorrectly assume tails is now more likely. This same flawed reasoning can negatively impact decision-making in trading scenarios. A trader might anticipate a trend reversal after a series of consecutive losing trades. This anticipation can lead to premature buying in expectation of an upward price movement. However, market trends are not always predictable and can persist due to underlying factors. If fundamental reasons support a continued downtrend, the market may keep declining. This scenario illustrates the risk of relying solely on pattern recognition without considering broader market dynamics. Short-term price movements in the market can often appear random. It is important to recognize and accept this inherent randomness. Avoid the gambler's fallacy, which assumes patterns in random events. Past streaks or trends do not guarantee future outcomes. Each market event is independent and not influenced by previous events. Understanding this helps in making rational investment decisions. Trading decisions should be rooted in concrete evidence rather than subjective feelings. Statistical edge, derived from back-tested systems, provides a more reliable basis for trading. Avoid relying on perceived patterns, which can be misleading and lead to poor outcomes. Subjective feelings about probability often lack the rigor needed for successful trading. Evidence-based approaches enhance the likelihood of making profitable trading decisions. In efficient markets, daily price movements are generally independent. This means today's price action is not heavily influenced by yesterday's. Trends are an exception to this independence. Trend analysis is necessary to understand and predict price movements during trends. Avoid relying on fallacies when analyzing trends. Use proper analytical techniques. Before executing a trade, assess the underlying reasons for potential market reversals. Determine if a reversal is supported by fundamental factors or merely a perceived streak. The gambler's fallacy is the mistaken belief that a streak of events influences future independent events. In trading, the gambler's fallacy can lead to incorrect assumptions about market direction. Avoid falling into the trap of thinking a series of gains or losses guarantees a change in trend. Base trading decisions on sound analysis rather than perceived patterns or streaks. Probabilistic thinking is crucial for informed decision-making in trading. It involves assessing the likelihood of different outcomes based on available evidence. In trading, probabilities should be derived from historical data analysis. Statistical modeling provides a quantitative basis for probability assessment. Avoid relying on recent sequences or gut feelings when estimating probabilities. Objective data analysis leads to more reliable probabilistic assessments in trading strategies. Trading strategies should be developed with a statistical edge. A statistical edge implies a higher probability of success. This probability is determined through analysis of historical data. Rigorous testing is essential to validate the statistical edge. The strategy's performance is evaluated using historical market conditions. Statistical edge enhances the potential for profitable trades. Backtesting is used to evaluate trading strategies. It assesses performance across various market conditions. Backtesting also considers different time periods. This process helps ensure strategy robustness. It also verifies the reliability of trading strategies. Ultimately, backtesting supports informed decision-making in trading. Effective risk management is crucial for protecting capital in financial activities. Stop-loss orders are a key technique to automatically limit potential losses. These orders trigger a sale when an asset reaches a predefined price threshold. Position sizing involves determining the appropriate amount of capital to allocate to each trade. Proper position sizing helps to control the overall risk exposure and limit losses from individual decisions. Trend analysis involves identifying patterns and directions in data over time. It is crucial to employ established trend analysis tools and techniques. These tools help determine the direction of a trend, whether it's upward, downward, or sideways. They also assess the strength of the trend, indicating how reliable the observed pattern is. Relying on the gambler's fallacy can lead to incorrect trend interpretations. Therefore, use analytical methods for accurate trend identification and forecasting. Trading decisions should not be made in isolation. It is crucial to consider the broader market context. This includes monitoring key economic indicators. Staying informed about relevant news events is also essential. Understanding overall market sentiment is important. Analyzing these factors can improve trading outcomes. Emotional discipline is crucial for successful trading. It involves maintaining control over one's emotions during trading activities. Avoid making impulsive decisions driven by fear. Greed can also lead to poor trading choices. Manage it effectively. The gambler's fallacy, the belief that past events influence future outcomes, should be avoided. Consistent emotional discipline helps ensure rational and strategic trading decisions. Continuous learning is essential for navigating dynamic market conditions. Adapting to change requires constant refinement of trading strategies. Regularly evaluate and update strategies to maintain effectiveness. Improving decision-making skills is a key component of continuous learning. Analyze past trades to identify areas for improvement. Stay informed about market trends and economic indicators. Traders should avoid making decisions based on superstitions or unsupported beliefs. Focus on rational analysis and logical reasoning when evaluating market conditions. Data-driven insights and evidence should guide trading strategies. Relying on superstitions can lead to irrational and potentially harmful trading behaviors. The gambler's fallacy leads traders to believe in predictable patterns within random events. This fallacy causes individuals to incorrectly anticipate outcomes based on past occurrences. Successful trading demands discipline and a well-defined edge in the market. A robust edge provides a statistical advantage, increasing the likelihood of profitable trades. Understanding true probability is crucial for making rational trading decisions. Relying on superstitions or perceived patterns instead of probability undermines trading success.